It begins with a paradox. In a nation built on the ideal that political power comes from the people, some of the most decisive forces shaping its democracy were not elected at all. They sat not in the halls of Congress, but in the quiet boardrooms of Lower Manhattan. While politicians delivered speeches about liberty, a small circle of financiers quietly rewired the machinery of American decision-making. This is the story of how Wall Street, through money, credit, influence, and the architecture of financial markets, helped shape modern democracy more profoundly than most citizens ever realized. To understand how this happened, we have to go back to the late 18th and early 19th centuries, when the United States was still in its fragile infancy. The country was drowning in war debt, its currency unstable, its government untested. Alexander Hamilton, the first Secretary of the Treasury, believed the only way for the young republic to survive was to anchor political stability to financial credibility. He invited bankers to play a central role in the national project by creating a public credit system, organizing federal debt, and supporting the establishment of the first bank of the United States. Hamilton's logic was simple. If the country could win the trust of the financial markets, it could win the trust of the world. But this set a precedent, one that tied political authority to financial confidence, and financial confidence to the handful of institutions capable of generating it. By the mid-1800s, Wall Street had grown from a cluster of brokers under a buttonwood tree into a powerful financial ecosystem. Its influence expanded during the Industrial Revolution, when railroads, steel mills, and oil empires needed vast amounts of capital. Bankers became kingmakers. Funding industrial giants meant influencing the shape of economic policy, labor law, and national development. J.P. Morgan, for example, didn't just finance railroads. He reorganized them, stabilized them, and occasionally intervened in government affairs when financial panic threatened the entire system. Then came the Panic of 1907, the critical turning point that revealed just how deeply Wall Street had become intertwined with the fate of American governance. When the financial system buckled, it wasn't Congress that stepped in, it was J.P. Morgan himself, orchestrating a private rescue to prevent national collapse. The spectacle of a single financier doing what the federal government could not was the final push leading to the creation of the Federal Reserve in 1913. With the Fed's birth came a new reality. Monetary policy, interest rates, and the stability of the entire economic system would now be guided by a central bank deeply connected to the financial sector. Wall Street's proximity to the mechanisms of national power grew stronger. As the 20th century unfolded, the Great Depression exposed the dangers of unchecked financial influence. Markets crashed, millions lost their jobs, and public trust in the financial elite evaporated. In response, sweeping reforms like the Glass-Steagall Act separated commercial and investment banking, while the Securities and Exchange Commission was created to regulate markets. These reforms sought to curb Wall Street's sway, but they also formalized the relationship between government and finance. Regulation required expertise, and expertise came from the financiers who understood the system best. The revolving door between Wall Street and Washington began to spin faster, creating a new class of technocrats who moved seamlessly between public service and private capital. World War II and the Bretton Woods Conference cemented the U.S. dollar as the backbone of the global financial system. This elevated Wall Street's influence beyond national borders. American banks, insurance companies, and investment firms became global players, shaping the flow of international capital. The Marshall Plan, designed to rebuild Europe, was as much a financial blueprint as a political one. Wall Street banks provided funding mechanisms, underwriting, and expertise that advanced American geopolitical interests while expanding their own reach. By the 1972, a new era emerged. The collapse of the Bretton Woods system, the rise of deregulation, and the explosion of global capital markets shifted power once again. Financial innovation from derivatives to leveraged buyouts gave Wall Street tools to influence entire industries. The deregulation wave of the 1,980 seconds and 1,990 seconds blurred the line between public and private priorities. Many policymakers believed that freeing markets would unleash prosperity, but deregulation also concentrated power. Mergers, acquisitions, and financial engineering became the engines of economic decision-making, often bypassing traditional political processes. Corporate governance, shareholder activism, and investment flows became invisible levers that shaped public policy outcomes. Meanwhile, campaign finance laws opened another door. Political candidates increasingly depended on financial contributions to fund their campaigns, and the financial sector quickly became one of the most significant sources of political donations. Elections grew more expensive. Lobbying surged. Expertise from Wall Street was sought after for economic committees, advisory boards, and cabinet positions. The U.S. Treasury, the Federal Reserve, and key regulatory agencies regularly drew leadership from major investment banks. Decision-making around financial crises, from the savings and loan collapse to the 2008 meltdown, was often guided by individuals who had built their careers inside the very institutions affected. The 2008 financial crisis was the clearest demonstration of Wall Street's influence in the modern era. The collapse of major institutions sent shockwaves across the globe, and once again, the government stepped in with extraordinary measures. Emergency lending facilities, bank bailouts, and massive monetary stimulus were deployed to stabilize markets. Critics argued that the response prioritized financial institutions over ordinary citizens, reinforcing the idea that Wall Street had become an essential pillar of political decision-making. But the crisis also revealed a deeper truth. Modern democracy had become structurally intertwined with financial markets. Retirement savings, mortgages, business loans, and government debt all depended on the functioning of Wall Street. If the markets failed, the democratic state itself risked faltering. Today, in the age of high-frequency trading, globalized capital, and trillion-dollar asset managers, the influence of finance is more subtle but more expansive than ever. Major institutions effectively shape public policy by determining which industries thrive and which fall behind. Asset managers vote on corporate governance decisions that affect workers, communities, and national priorities. Technology firms backed by venture capital reshape societal norms before regulators even understand the implications. And as wealth inequality grows, financial power increasingly aligns with political voice. The ability to influence elections, legislation, and public discourse is magnified by capital, and capital remains concentrated disproportionately in the hands of those tied to Wall Street. Yet the story is not simply one of control or conspiracy. It is a story of interdependence. Modern democracy relies on functioning financial markets just as financial markets rely on a stable democracy. Each supports, restrains, and challenges the other. The question facing the 21st century is whether this balance remains sustainable. As the financial world becomes more complex, the stakes grow higher. A disruption in capital markets can destabilize everything from jobs to housing to national security. Conversely, a political system captured by financial interests risks undermining the democratic legitimacy on which the economy depends. In the end, Wall Street's influence on modern democracy is not the result of a single event or a hidden master plan. It is the cumulative outcome of centuries of decisions, some deliberate, some accidental, linking finance and governance together. The birth of public credit, the rise of industrial capital, the creation of the Federal Reserve, global financial integration, deregulation, and crisis management have all woven Wall Street into the fabric of American political life. Understanding this relationship is essential because democracy is strongest when its mechanisms are visible, accountable, and understood. The story of Wall Street in democracy is ultimately a story about power, where it comes from, how it moves, and who gets to shape the future.